When you think of charitable giving, your mind might go straight to cash donations. But there's another way to make an even bigger difference, both for your favorite causes and for your own financial well-being. Donating appreciated assets, things like investments, real estate, or valuable collectibles, can allow you to give more without spending more. It's a strategic approach that combines generosity with smart tax planning. So, why consider donating appreciated assets instead of cash? First, it allows you to give beyond your checking account. Many people have investments or property that have grown in value over time. These assets can be powerful tools for charitable giving. Second, it lets you support the causes you care about most in a more meaningful way, often enabling you to make a larger gift than you might otherwise afford. Third, by leveraging the value of assets like stocks, real estate, or collectibles, you can gain significant financial and tax benefits. You'll potentially lower your tax burden, amplifying the impact of your generosity. In short, donating appreciated assets can help you do more good with the resources you already have. Appreciated assets are investments or properties that have increased in value since you acquired them. Instead of selling them and donating the proceeds, you can donate the asset itself to a qualified 501c3 charity. This method often benefits both parties. You avoid certain taxes, and the charity receives the full value of your gift. These assets might include publicly traded stocks, real estate, or even artwork. Really anything that's worth more now than when you bought it. Let's look at a few common examples. Stocks and mutual funds first. These are among the most popular assets for charitable contributions. If your shares have appreciated substantially, donating them directly lets you skip capital gains tax and support your favorite cause at full market value. Real estate properties, such as vacation homes, rental units, or commercial buildings, often appreciate significantly over time. Donating them can generate a large charitable deduction while avoiding taxes on the appreciation. Lastly, artwork and collectibles. Fine art, jewelry, and other valuable items that have gained value can also be donated. These gifts can be especially impactful for museums, universities, or cultural institutions. There are four main financial advantages to donating appreciated assets. 1. Avoid capital gains tax. When you sell an appreciated asset, you generally owe tax on the increase in value. By donating it directly, you skip that tax entirely. 2. Charitable tax deduction. You can usually deduct the asset's fair market value if you itemize deduct on your tax return. 3. Maximized philanthropic impact. Because no tax is taken out, the charity receives the asset's full value. 4. Reduce estate taxes. Donating appreciated assets can help shrink your taxable estate, which may lower future estate tax liability for your heirs. This combination of benefits makes donating appreciated assets one of the most tax efficient ways to give. Here's where the numbers really tell the story. Imagine you purchased a stock for $10,000 and now it's worth $50,000. If you sell it, the $40,000 gain is taxable, potentially costing you $8,000 in capital gains. That leaves you only $42,000 to donate. But if you donate the stock directly to a qualified charity, you pay no capital gains tax. The charity receives the full $50,000, tax-free, and you can claim a charitable deduction for the same amount. In other words, donating the asset directly keeps your dollars working where they matter most, with the charity. When you donate appreciated assets, you can generally deduct the fair market value of the asset at the time of the gift. There are a few important IRS rules to keep in mind. The deduction is typically limited to 30% of your adjusted gross income for gifts of capital gain property to public charities. If your donation exceeds that limit, you can carry forward the unused portion for up to 5 years. The assets must be held for more than 1 year to qualify for the full fair market value deduction. For example, If your adjusted gross income is $500,000 and you donate $200,000 worth of stock, you can deduct $150,000, 30% of your AGI, this year and carry forward the remaining $50,000 for future years. When you donate appreciated assets, everyone benefits. The charity receives the full market value of the asset, no taxes deducted. You receive a larger tax deduction, and your taxable estate is reduced, which can help minimize estate taxes in the future. It's a win-win approach that transforms your appreciated investments into long-term support for the causes that matter to you most. Let's compare two approaches. If you sell $50,000 of appreciated stock with a $10,000 cost basis, you might owe around $8,000 in capital gains, leaving $42,000 to donate. But if you donate the stock itself, the charity receives the full $50,000 and you claim a larger deduction. A few notes. If the assets have been held less than 1 year, your deduction is limited to your cost basis, not its appreciated value. For non-cash donations over $5,000, you'll need a qualified appraisal to substantiate the deduction. The process is straightforward if you follow these 5 key steps. 1. Choose a qualified charity. Make sure it's a 501c3 organization that aligns with your values. 2. Determine the asset's eligibility. Publicly traded securities are easy to transfer. Real estate and collectibles may require more coordination. 3. Arrange the transfer. Work with your broker or financial institution to transfer ownership, or with a title company if it's real estate. 4. Value the asset. If your donation exceeds $5,000, other than publicly traded stock, you will need an appraisal. 5. Retain documentation. Keep records of the transfer and file IRS Form 8283 with your tax return for gifts over $5,000. Following these steps ensures your donation qualifies for the full tax benefits. Appraisals are critical for tangible property donations over $5,000. Here are a few guidelines. The appraisal must be completed before your tax return is due for the year you claim the deduction. The valuation date can't be earlier than 60 days before the gift. If done after the gift, the valuation date must be the date of the donation. Timely and accurate appraisals are essential to preserve your deduction and meet IRS standards. While donating appreciated assets offers many advantages, it also comes with a few complexities. Valuation challenges. Inaccurate appraisals can risk your deduction. Charity acceptance. Not every nonprofit can handle non-cash gifts like real estate or art, so confirm beforehand. Deduction limits. Remember, deductions are often capped at 30% of your adjusted gross income, though unused amounts carry forward for 5 years. Financial consultation. Work with advisors or tax professionals to ensure your donation fits your broader financial strategy and meets IRS requirements. A little planning goes a long way towards making sure the gift is both impactful and compliant. Real-world examples show just how powerful this strategy can be. Example number 1, a stock donation, helping healthcare research. A donor gives $100,000 in appreciated stock, avoiding $20,000 of capital gains, claimed a full deduction, and funded critical medical research. Real estate, funding a university scholarship. A couple donates a $1.2 million property to a university. Their gift establishes a scholarship fund and reduces their estate taxes. Art donation to a museum. A philanthropist gifts a valuable piece of art to a museum, expanding its collection while receiving a fair market value deduction. Each example shows how financial strategy and philanthropy can work hand in hand. Donating appreciated assets is one of the most powerful ways to align your financial goals with your charitable values. It allows you to give more, save on taxes, and create a lasting impact, all at the same time. With thoughtful planning and the right guidance, you can transform your investments into meaningful change for the organizations and communities you care about most. Generosity is most effective when it's intentional.